I think there's going to be opportunities. Lots of debt is maturing in the next 2 years, which is going to force sponsors' hands positively or negatively. But I think it's going to be relatively short-lived because the percentage of properties that actually have a problem is very low in a larger scheme of things. And there's tremendous amount of dry capital or dry powder that's on the sidelines ready for those opportunities. So I think it will be problematic, but it's going to be very short-lived.
Hi there, I am Adam Gower, founder of Gower Crowd, and welcome to this next episode of the Real Estate Reality Show. Today, my guest is Cody Charfauros, principal at Slatt Capital in San Diego. I'm going to let him do his own introduction of what they do over there. But I met Cody via LinkedIn, actually, posted a very interesting post that describes the way that floating loans are causing considerable distress in the commercial real estate industry. And our conversation today gets to the heart of what's really going on in the market. It's not just commercial real estate that is suffering, but it is also regional banks. And Cody describes two scenarios that he is seeing with regional banks, how they are dealing with these subpar, I mean, they're not subpar, but this circumstance where interest rates have gone up and borrowers are unable to meet their obligations and values have come down. So there are some severe implications for regional banks. We talk about how to find those that are probably having a harder time than others. Very interesting discussion. Cody is very, very well tuned into what's going on, and you're going to enjoy this conversation very much indeed. Please go to gowercrowd.com to learn more about Cody. I'll put some links in there, including a link actually to the LinkedIn post that drew me to him in the first place. And while you're there, subscribe to our newsletter. And then the other thing, if you have the inclination, these are all videos. So go to YouTube. Actually, I think you go to YouTube.com/Gower Crowd, actually, and subscribe to the channel over there. And if you have the inclination and you have some thoughts, please go ahead and pop them in the comments. I would be more than happy to engage with you in dialogue over there on YouTube. All right, that is enough of my introduction. Let's get on with it. Cody Charfauros from Slatt Capital, here he is. Cody, nice to meet you. Thanks so much for joining me on the podcast today. Before we get started, tell me a little about what Slatt Capital does, just ever so briefly, your background, so that the folk listening and watching know who they're talking to or who they're hearing from.
Sure. Yeah. Thanks for inviting me. I appreciate the opportunity. So Slatt Capital is a privately owned mortgage banking firm based in California. We work nationwide with clients on their investment properties, primarily in long-term financing. And what we specialize in is our correspondent life company lending. So it's longer term, higher quality, but nationwide for private clients. So middle market space, loans in the $5 to $45 million range.
Okay. And any particular asset class focus?
Everything under the sun. We do a lot of retail. We're pretty well known for retail. But we do multifamily, a little bit office here and there, and industrial, and then self-storage and all the various other asset classes.
Right. So this is why I asked you to come on to the podcast. I'm going to actually read this. So Cody put a post on LinkedIn that actually almost exactly replicates some data that I'm putting into an investor presentation I'm doing. Passive investor training, actually, on what distressed real estate looks like. Almost the exact same thing, but this is what he wrote. He said, here's an excerpt from our recent capital markets update. We'll talk about that right now. That's what we're going to talk about. It says, we're tracking lots of actionable trend data, including our proprietary database of real-time loan quotes. Very interesting. Contact me if you'd like a custom Zoom or in-person update for your team. Well, that's exactly what we're doing.
Here we are.
For the world to tune in and listen to. All right, so here's what Cody put up on LinkedIn, and if you go to the Gower Crowd website, gowercrowd.com, and look for the podcast or for this conversation with Cody, I'll post a link to the LinkedIn post that he put up there. But the post basically considers a $10 million property value. Actually, why don't you describe it? Have you got it in front of you?
Sure, yeah.
I can actually, you know what? Why don't we do this? I'm actually going to share my screen as we are doing video, and you can actually walk through it because I'm going to be slightly naughty. I'm going to confess. I'm actually going to ask some of the questions that some of your correspondents asked on LinkedIn as well. It's a bit of a lazy way out, but there's some good questions here. So why don't you start describing what this chart is about for somebody who can't see it, and then let's talk about what's going on here.
Sure. So this is an illustration of the big problem that a lot of sponsors are finding themselves. And by the way, we can get into this later, but the background of this is actually I'm a sponsor and I'm in this problem. So I can relate to our clients that are in this position. So the idea is to consider a $10 million loan value and your typical 65% loan to value loan at $6.5 million in this example. Now, if we apply a 5% cap rate, as many of your viewers know, a capitalization rate is the income on an annual basis that an income property can generate or does generate after all expenses. So that's a 5% cap rate at $500,000 NOI. And the interest rate as originated perhaps originally in January of 2022 on a floating rate basis versus the interest rate as of April of 2023. And so it shows the difference between those two numbers, which is a dramatic difference.
Okay, so let's talk about what those numbers are. And actually, let's drill down on this. So you've got a couple of numbers here. You've got the SOFR, and I had to look this up. I should be embarrassed to even admit that, but I'm going to admit it anyway, which is the secured overnight financing rate,
yes,
SOFR, and you're showing January 22, 0.05%, April 23, 4.81%, and the all-in rate, January 22, 3.05%, April 23, 7.81%. Oh my goodness. Those are massive shifts. What is the difference between the SOFR and the all-in rate? Why does it matter? Why do we need to know about the SOFR?
Yeah, so floating rate loans are based on a floating rate index plus a margin, a spread, profit margin, if you will. The old way of doing that was LIBOR. The new way of doing that is SOFR, but they're essentially analogous. SOFR, SOFR, is tied very closely to what the Federal Reserve's Fed funds rate is targeting. It's not a one-to-one relation, but it's tied very closely. And really what this rate is what the banks charge each other to lend to each other overnight. And so what this number captures is what really the rate is for them to sort of borrow free money against one another. And then you add a margin on top of that to get to your final rate. And the margin is the bank's profit margin. So this illustration shows that in January of 2022, the average SOFR rate was around 5 basis points or 0.5%. Then the Fed began their major increases in their target rate for the Federal Reserve Fed funds rate. And as of April of 2023, that same base level rate was now 4.81. Now, if you were to originate a loan back in January of 2022, the bank would have said, hey, I'm going to give you a loan, and let's say we give you a loan plus 3%. Your all-in interest rate that you'd be paying on for the month of January or February would be the 3.05%. But it's a floating rate loan that it's not capped. It's, or maybe it is capped, but it's floating rate and it resets. And that same interest rate, because the SOFR index has changed during that time due to the Federal Reserve, is now 7.81 because it's 3% over. And so you can see what that does to the monthly payment, nearly doubles it.
So it goes from $27,000 a month in January 22 to almost $47,000 a month in April 23.
Correct. Yep. And then now what's important here is that the income in our assumption hasn't changed. Now maybe it has slightly. Maybe you've got 5% increase in rents or what have you. But for the most part, we're assuming that their income is basically flat, which is the case for a lot of our investments. But your annual payment has increased like crazy. So on an annual basis, the debt service coverage ratio or debt coverage ratio, DCR, on a 30-year amortization basis has gone from 151, which represents your after your loan payment, you still have around 50% of the cash flow left over for the sponsor's profitability, for them to go invest elsewhere, et cetera, down to a 0.89% debt service coverage ratio, which essentially means the property income is not sufficient to even carry its own debt.
Right, and that is very profound, isn't it? So what does that mean in terms of, so we've been talking to, we talk to banks and bankers all the time as well at the moment. And can you comment on what that means as far as how lenders are how are they carrying these kinds of loans on their books? Let's say that you are continuing, and by the way, I will definitely share with you what I'm hearing, but I want to hear from you first, and I want to put words into your mouth. But what you basically got here, even if a borrower who is now underwater on their loans, they don't have enough income to service the debt anymore. So let's say, for argument's sake, that they are dipping into reserves to continue paying on time. How are lenders viewing a situation like this, as far as you know, where the DSCR, DCR has actually gone negative?
Yeah, there's a couple of takeaways, I think, from these simple numbers. The first one is to say, look at January's underwriting assumptions. That was a conservative loan. Made all of the sense in the world to do this loan. So I think the story is we didn't get over our skis originally. However, the new pressure of higher interest rates is now taking formerly good loans and making them bad loans. So to answer your question directly, what are the bankers doing about this? Well, as you know, and as many of your viewers will know too, especially the regional banking space is in a time of turmoil. We don't quite know who's going to be the net beneficiaries or the net losers of this scenario in terms of deposit runs and governmental oversight. And so for that reason, the regional banks, which have an outsized portion of this floating rate style debt, are looking closely at their portfolios, and they're seeing if loans are underwater, are not underwater, or if there are workout scenarios that they need to look ahead at. Now, a lot of these loans have not yet come to maturity, so they're not necessarily in, say, a maturity default scenario, but they very well may be in a default, technical default, because of the debt service coverage ratio covenant or other covenants, even without going and getting an appraisal and arguing that the value of the property may be lower because of this. So they're looking at it. Now, if you're a regional bank that's having regulators breathe down your neck because you've had a major deposit outflow and you have a loan like this on your books, their motivation is very different than another bank that doesn't have a lot of deposit problems and doesn't have the regulators breathing down their neck. So it varies is the answer, Adam. Some of them are looking at this and calling up their borrowers and saying, I need this loan off of my books right now. Otherwise we're going to foreclose on the property. We're getting phone calls from our clients that are hearing that exact thing, even for their best depository relationship borrowers.
Really?
There are other lenders that say, okay, you're in trouble for a time. We think that this is temporary. Maybe we will, grant relief for a while. We won't call you in technical default. We think that this is going to clear itself, so we kick the can down the road a little bit. So I think we're hearing both of those stories, and both of them are totally valid. They just come from completely different perspectives.
That's really interesting. So and I'm so happy you said kicking the can down the road, because That was actually the note that I put here to remind myself to ask you about. So let's talk about that in a moment. But so you're describing banks, some of the regional lenders who are concerned about what might be heading their way, forcing sales, calling borrowers and saying, "Hey, look, we need this loan off our books quickly." What is that conversation actually leading to? Is it like sell the prop? Are they forcing a sale on the open market? Like, what does that mean exactly?
So they can't necessarily force a sale, but they can force a default scenario, which either injects default interest, which increases the interest even more, which would make it even more underwater, which probably isn't good for anybody, not good for the bank, not good for the borrower. Or they could simply just say, we're going to foreclose on the property, or we give you 30, 60, 90 days to pay us off without the foreclosure headache in proceedings. And so the borrower then goes to a firm like ours and says, hey, we're in trouble. We need this thing off the books of my bank. What are the options? And when we look at the deal in today's environment, the options are challenging. The options could be you need to bring in more capital into it. So I think you had a previous guest that talked about rescue capital. That is definitely a scenario that we see more and more these days. Lots of people talking about it, lots of people raising funds for it, and dry powder coming out of the woodworks to try to solve some of these. And there's lots of ways you could slice that question. But generally speaking, putting more capital into it and then doing a refinance at a lower loan amount. That does work on a debt service coverage basis. The other option is often they are currently on a floating rate loan, which is in the 7s, 8s, 9s. We could refinance that same loan if it was conservatively underwritten into a permanent loan that it has a 4, 5, or 6% handle. Now, because that is a lower interest rate, we see sponsors taking on permanent loans, fixed rate loans, a lot sooner than they were originally anticipating. Maybe it's a construction loan that had a floating rate component, or the whole loan was floating rate, and they're just at the cusp of delivering the building. Their original business plan maybe was to float it for another year or two to get the leasing up and then sell the property. Now they see maybe this is 2 or 3 years down the road or even more, and I'm in trouble today, so let's do a 3-year or a 5-year fixed rate loan with some prepayment flexibility, so we can I as a borrower can kick the can down the road on this financing or sale problem and just buy myself some time.
And are you seeing some banks also who are kicking the can down the road? What do they do? I mean, I don't want to again use derogatory terms, but turning a blind eye to these as long as borrowers continue to. So what I've heard is that as long as borrowers continue to keep loans current, there's an acceptance that values have come down substantially, and as long as actually the DSCR remains above 1, they're okay with it.
Yes.
What does that mean? What does it mean to be kicking the can down the road? What is the hope, do you think, that this approach is harboring?
Yeah, I don't know. I tend to be a little bit of a pessimist when it comes to what is the greener pasture on the other side of the hill. I just don't know that there is one in a few years. So kicking the can, I think, is a delay of the inevitable in a way. But on the immediate basis, what the banks are doing, especially the ones that are have some problems, are playing triage. So the ones that are really, truly, truly problematic, they are going to move on, and they do it quickly. Kicking the can down the road doesn't make sense for that type of asset. But many of the other ones it does. So yes, maybe it's a 1.0 DSCR. We just sort of ignore our covenant. We don't call you in technical default, and we'll relook at it in 30, 60, 90 days and see where we are at now. Another version of this is similar to what we saw a lot during the COVID shutdowns, which is you're currently on a 30-year amortization, which is putting a challenge on your DSCR. Maybe we grant you 30, 60, 90, 120 days of interest only. just to, again, keep the property floating, and then in that time frame, relook at it. And I think you're going to see more and more of that type of thing, concession granted, just to work out the deal, allow maybe time to go over or get their listing agreements penned and buyers in tow, and then the lender is solved by being paid off from a sale.
Is there, I've heard talk of, I want to say, is it 35 or 40-year amortized residential loans? Is there any extended amortization scenarios for commercial? Because that reduces the monthly payment and helps.
Sure. Yeah, on the multifamily side, they can underwrite to a 35-year amortization. There's also a few products from HUD that can go to 40-year amortization. But on the commercial side of the business, it's incredibly rare. Most of the amortizations is limited to 30 years. And if it's longer than that, it's just interest only.
Oh, it is IO. I see.
Yes.
All right. So big question here, obviously. So what, I'm kind of going out of order, but is it possible to identify? So you've described two types of banks, those that are kind of kicking the can down the road towards the inevitable, right? Potentially. And then there are those that are pragmatically looking at their assets, their loans, and addressing and talking to their borrowers to try and figure out ways of cleaning up their balance sheet, right? So the pragmatists and then the optimists, I guess you would call the two different types. Is it possible to identify which actual banks are doing what?
That's the billion-dollar question for sure, Adam. As you know, the shorts have a pretty good idea of who is in trouble and who is not in trouble based on their balance sheets and the way they have to now account for a lot of the lending that they've been doing over the last few years. One other small indicator that I've been looking into myself is who are the regional banks that extended the most amount of PPP lending.
Oh.
A little tidbit a friend of mine gave me was at one of the major headline banks that have been in the news recently, they did a very large outsized portion of PPP lending. And the tidbit was the lending was done. It was put into a balance on a new account for a particular borrower. And then it just sat there because the borrower, for example, made their payroll by other means. Their sales were great, whatever, but they got granted the PPP loan, and they did get the PPP forgiveness. So the balances just sat there. And so what did the bank do? They had a higher amount of deposits. Therefore, regulatory-wise, the regulator said, hey, go lend more. And they did. They lended more at very low interest rates. And now what we're seeing is that those banks are now having to write down the value of those loans. Depositors get spooked, everybody moves out, bank goes under. I think there's going to be more of that. So the regional banks, which did an outsized portion of the PPP lending, I mean, we're talking $8 billion of PPP put out in two phases. There's
trillion, I think.
Or maybe it's trillion.
Was it billion? Whatever it was, lots of
money. I mean, 8 billion is not a
not
small amount of money. It's not a huge amount of money, obviously, by any means. But nonetheless, if there was a huge amount of money printing and it went and sat, and lots of people looked at deposits as being the means of, oh, now we have to go and lend. And then now they've done it, and we've written down all of the loans that we just leveraged a problem, regardless if it's 8 billion or 8 trillion. We've leveraged the problem and made it worse. And that's what I think we're going to see. So I'm looking at who are the regional banks that did the most amount of PPP lending and looking at their balance sheets.
So just to kind of wrap up this theme. So how do you identify the shorts? Like who's shorting what? I don't know. I'm like not a stock guy at all. So I don't even know where to look. Where would you look to find what banks are being shorted the most?
Your guess is as good as mine. I see every day Wall Street Journal and Bloomberg, lots of noise about what the shorts are doing or not doing, saying, not saying. There's lots of activity on Twitter. There's lots of activity in places like Reddit. So I think there's a way you can track it from there, but I'm actually suggesting maybe don't talk to the shorts and go look at who did PPP.
Yeah, interesting. So which sectors do you think are going to be the hardest hit asset classes, real estate asset classes in this kind of, this scenario of rising interest rates?
Well, on the floating rate exposure, it's going to be construction lending of all stripes, which has primarily been in multifamily, mixed-use projects, and industrial. So the sponsors that have taken on that kind of debt, that's going to be the most problematic immediately. On a bigger picture basis, commercial real estate generally has challenges. Lots have been said about the challenges in office. That is going to continue. It is not overblown. There are absolutely major challenges in the office sector. But the ones that were particularly overheated, I think, are the most problematic, and that is the multifamily and the industrial space, even though the fundamentals of those two asset classes is as solid as can be. It's really just about the way the capital was structured and relative to where interest rates are today that is messing everything up for those two asset classes.
That's interesting. So let's drill down on multifamily specifically. It's interesting you say the fundamentals are strong. That's what the kind of the pushback one hears from advocates for multifamily in the market, particularly those raising money who have raised money from individual investors. Is there a distinction between within the multifamily market? Are you seeing any indications of, I'm trying to think of the right words, distinctions between different kinds of sponsors, this kind versus that? I see you nodding, so please help me out here. You know where I'm going with that.
Yeah, I mean, just to give you a bit of background on myself, I'm a general partner on a multifamily development. I mentioned to you that the problem that I illustrated in my LinkedIn post was really my problem in a way. So I'm on it as a sponsor. And then I'm also a limited partner on 3 smaller syndications as well. I think what we're going to see is that the syndicators or the sponsors generally that maybe are just using their own capital that are underwriting 20, 25, 30% year over year rent growth in multifamily are going to not be able to justify that any longer. I think that's already the case, especially in certain markets in the Southeast. And even the best, quote unquote, best West Coast markets have problems with rent growth. So I think the issue is more of an expectation issue than it is a fundamentals issue. Is there rent growth year over year in basically every market for multifamily? The answer is yes. There's still rent growth. It's just not 25, 30%. It's 15, 20, maybe 5% in the worst areas. There's Bay Area, some parts of LA, there are definitely rents that are down year over year. But generally speaking, nationwide, multifamily is still very healthy.
Yeah, I've had this conversation this week already, as you know. It is, to me, mind-blowing. I cannot imagine ever underwriting a rent growth assumption at 20%. I don't care what it's been doing historically. I could never personally, with a straight face, put those numbers into a spreadsheet and figure, oh, look how much money we're going to make. But that is also part of the reason why I see so many deals these days that really don't make sense. And over the last few years, same thing entirely.
So, I mean, without putting too fine a point on it, Adam, I think what we're going to see, especially in the multifamily syndication space, is you're going to have 2 classes of syndicators. You're going to have a class of syndicators that truly know what they're doing, that are going to outperform their own expectations, and they're going to be trustworthy. And you'll see those sponsors do quite well in this environment because they'll be able to see through the BS of certain deals, but you also will see lots of real estate investors flock to them away from the other category, which is We're hitching our wagons to 25% year-over-year rent growth, 40% year-over-year cap rate compression, and in 12 months we're out and we printed money for everybody. I think that latter scenario, which truly has been the rule, not the exception over the last couple of years, is going to have to adjust and hopefully go away.
All right, last question. Actually, I like to say this. My last question before my final question. Timing. So here we are. I'm going to date stamp this thing. We are, what are we? 10th of May, 2023. So what is the prognosis? We're going into a election year. Next year, Fed has indicated ever so subtly that they've hit pause on rate increases. It's clearly a lag effect on the prior rate interest increases. What's the timing? What do you think is going to happen? Or what should investors be looking to expect over the next 6, let's call it, to 12 months?
Yeah, so I'll preface it by saying every time I've made an interest rate prediction, I've been absolutely wrong. So
perfect. You're the perfect person to talk to then. Whatever Cody says, bet the opposite.
Do the opposite, exactly. That being said, it seems reasonable to me to expect that if the measures that the Federal Reserve is looking at start to loosen up, that they will react in kind. Although I think they're going to react in kind a lot slower than they reacted the opposite direction, and even a lot slower than many of the prognosticators would suggest. Even if there is a full-blown recession that they can document, I personally believe we already are in one, but that they can document and believe, I think it's a long time before they do anything dramatic without another big watershed thing like COVID-19 occurring. So my prediction is interest rates this time next year will be slightly lower than they are today. But I do not believe that we're going to get back to a 2 and 3 average interest rate. That's historically ridiculous, and it's hard to justify a 0% interest rate for very long. So I do think we're going to have average interest rates in the commercial real estate space. Instead of being in the 5s and 6s, we'll be in the 4s and 5s. And that's back to sort of a 10 or 15 year normal.
And as far as commercial real estate, distressed commercial real estate, do you see there being a clear out over the next few months? And if so, when do you think that's going to kick in?
I think there's going to be opportunities. Lots of debt is maturing in the next 2 years, which is going to force sponsors' hands positively or negatively. But I think it's going to be relatively short-lived because the percentage of properties that actually have a problem is very low in a larger scheme of things. And there's tremendous amount of dry capital or dry powder that's on the sidelines ready for those opportunities. So I think it will be problematic, but it's going to be very short-lived.
Yeah, you and I are exactly the same mind, actually. I was talking to R.S. Manzi, who is managing editor, I think, at CREnews.com, a TREP subsidiary. And he said, yeah, there's a lot of trillions of dollars sitting on the sidelines. But what does that mean? It means it's not in the market. So that creates liquidity issues also as banks start to pull back. Liquidity crisis is what drives prices down, because, right, in part anyway. So my sense actually is that if the second the Fed decides to reduce rates again, even if it's just a quarter point, that will trigger a massive run into the market, because that's going to be quick before all the good stuff is gone. That's what I think you'll see happen. I think you could turn the spigot on just like that. But that, again, could have inflationary impact as well if all this money does suddenly come in at the same time. Cody, truly my last question. What resource, and I'm asking this of everybody, what resources, online resources, media, and etc., do you use, or proprietary databases, but do you use that viewers can also access to understand what's going on? What are your favorite resources for understanding what's going on in commercial real estate?
Sure. I mean, besides the obvious Bloomberg and Wells Fargo, Wall Street Journal, I follow Peter Linneman's letter. I think that's a tremendously great resource. And the Willie Walker podcast is great. I know you had Willie on your podcast a few months ago. Everything that they put out is absolutely gold star. And then we track a lot with Real Capital Analytics, MSCI, what the Mortgage Bankers Association, which we are a member company, puts out on default rates and maturing loans and what have you. I think is a pretty good thing to track. If you're a sponsor, even if you're not involved in the debt markets, you're going to see what other people's decisions are going to be motivated by. So those are the few major things that I track a lot.
Cody Charfauros, Principal and Managing Director at Slatt Capital. What an enormous pleasure. Thanks so much for joining me on the podcast today.
Thank you, Adam. It's been a pleasure.
Hey, thanks for listening. That was Cody Charfauros of Slatt Capital, Principal and Managing Director at Slatt Capital there in San Diego, talking about actually some realistic, truly realistic circumstances that he is facing personally, and also reviewing what's going on in both commercial real estate and banking. Very, very interesting times that we are living in. Please, if you like this show, if you're finding you're getting some value out of this, do please share this with some friends and colleagues. We're really working hard to give you content of very high value that is immediately usable, right, and tangible, help to guide actually all of us through these turbulent times. I invite people on because, you know what, nobody really understands what's going on. So I like to ask people onto the show who can help guide me through what's going on and to make the right decisions and to find it, candidly, to find some opportunistic acquisition possibilities or deals as the market starts to turn around. So as I ask them these questions and ask them to provide me some guidance, hopefully you're getting some value out of that as well in the same way that I am. Cody, thank you for having joined me. It was a real pleasure meeting you. Let's definitely stay in touch. And also thank you to a dear viewer for joining me today. I'm going to sign off now. I am Adam Gower. This is the Real Estate Reality Show. Thanks so much for joining me. I'll see you next time.